Hi everyone, it is December 16, 2022. This is Nikki and you're watching the awesome 10x Global Market Updates. Today is the day where I'm going to discuss you alternatives to short selling. Traditionally, I believe that most Filipinos or those who are looking to make money or generate income in a falling market, they usually think that shorting shares is the way. Well, there's actually a lesser risk form to actually short shares. And today we'll be discussing how to employ bearish put spreads and how to utilize bearish call spreads, even if you may not have understood what options are. I promise that we would go beginner style. So please bear with me and we will explain how to generate income in a widely falling market. Okay. So let's begin. For those who are new here, let me also try to discuss that we are actively promoting as well the utilization of Webull. So here you're also I'm gonna share my Webull account. Webull account is so I'm using only 3 brokerage firms. So you will be seeing me open eToro, Interactive Brokers, and Webull. I think all platforms are useful and each of them have their own use cases. So let me share to you my Faces Trader account, which is my Twitter account as well. Please follow me on Twitter at Faces Trader. So yes, I am a chartered market technician as well. So this is a free Friday class. So if you're new here, please don't forget to like and subscribe and watch and repeat our classes every Friday. So just wanted you to know that Webull is actually giving a reward of about $100 if you fund your account with just 2,000 Sing. That's quite a big cash voucher as long as you buy one stock or ETF. Don't worry if you're bearish the market, you can always buy a short leverage fund. Now you need to maintain that fund for 30 days before you withdraw that. And you need to buy one US options. And if you do that, then you can buy, you can get a $50 cash voucher. So you do this until December 31 and you can enjoy a 0 fee for any subscription and redemption of mutual fund shares if you ever so wish. Webull also offers the best place to buy your US markets and Hong Kong stocks. They have a 0 commission rate for trading stocks, ETFs, and options for US and Hong Kong, which I really like to employ. And then you can, of course, own fractional shares for as little as $5. And you can now open your actual account, even if you have a Philippine visa, Philippine passport, everything. It's just Philippine citizens can open. But take note that this is a Singaporean firm. So you are actually depositing your money in a Singapore account. So those with the Philippine bank dollar accounts must actually make a telegraphic transfer, 2,000 Sing minimum, towards the Webull Singapore account. So it is quite convenient actually, even if we're Filipinos. But of course, it's more convenient to those Filipinos who are residing in Singapore already. So you can actually just log in and actually go to Apple App Store. You can open a mobile account. So what I've done is I went to the Apple App Store. I moved my country region to Singapore only just for the sake of opening. And then, of course, when I came back to the Philippines, I changed and reset my country region back to the Philippines. So that's not a problem, so that you can just download the app because the Webull app in Singapore is the only one that has the active trading part. So I think if you only downloaded the Philippine app in Webull in the Philippine store, there's no trading function. So only be able to see just viewing, etc. So in today's topic, of course, I'll be discussing how I've been using Webull and Interactive Brokers and also eToro to actually manage money in a falling market. Okay, so let's begin, guys. Let's discuss how to actually generate income in a falling market. Okay, so this is our account. You can actually see that in the link on the thumbnail. And let's begin. So it's actually e.webull.com.sg/i/awesome10x. Okay, so let's share your slides for today. It's December 16. It's 9 days before Christmas. It's just a week. So advance Merry Christmas for everyone here who's still watching Awesome 10x. Thank you for watching. So let's take a look on alternatives to short selling and how to generate income in a falling market. We can actually learn bearish puts, which are debit spreads, and bearish calls, credit spreads. So these are actual examples that we've done for these types of spreads. You can see that this was a Berkshire bearish spread. This is a January 2023 310 300 bear put with a cost of $3,000. Last night, it was up 58%. So we generated about $1,800 so far. But actually, this Berkshire bear spread has a 1:3 risk reward, meaning if Berkshire breaks 300, there's a high chance that before January 2023 that we would reach that more than $3,000 of profit. You will see that we have a SPY bear spread. This already reached our target. With bear calls, what you'll learn later on is that bear calls only have a maximum gain of 100%, wherein we receive $1,050, and after 3 days since execution, it already reached 95% of the total credit received, which is $980. So this one, I actually closed this last night. This was a screenshot of last night's trade. NVIDIA bear spreads. This is an NVIDIA bear put. So this one was up 100%. This one is still held because all the bear spreads that you will learn today is actually a way to generate income in a falling market. And you can see the difference between the risk employed. You could see that for NVIDIA bear spread, my total cost was $883. And actually, I could gain more than 200 to 250% on this specific position. So actually, this was a risk of about $150 and a gain of $350. So for every contract, I could potentially earn about, so 350 times 6, potentially $2,000 with a risk of only 883. Compare that to an NVIDIA short, which I also did on the same day. NVIDIA fell 6%, earned $556 with more risk actually rather than just deploying bear spreads. I did that just to really show to you the differences between shorting shares and actually employing a bear spread and different bear spreads. You can make an NVIDIA bear spread that is expiring December 30. You can make an NVIDIA bear spread that expires 6 months from now. And you can see that the one that's still 6 months from now is just up 10% so far, due to the fact that they have very little delta when you actually employ a longer term expiry. So I'll discuss all of these, but you can see that bear spreads and bear calls are actually very effective in a market that is very much madly in the decline. So I know that this might be too much jargon. So let me show to you the marketplace last night and what is expected over the next couple of weeks and until next year. So you can see that the markets this week, it was a pivotal week. Obviously, this week has been about the soft CPI data. So everyone is accepting of the fact that inflation has peaked at 9.1% during September and has since fallen to about 7.2, 7.1% last month. So you're seeing that the market has been rallying over the last 2 months over the fact that inflation has peaked. So now the narrative has changed, not about inflation, but actually on next earnings recession. So are we going to get downgrades? Are we going to get consumer sell-off, retail sales declining? So far what we've seen on data is that slower sales has really affected the market, and the Fed making the hikes on a sustainably restrictive mode wherein you still have high rates, sufficiently restrictive Fed, has really made the market fall down, especially after the Fed rate hike, which still hasn't ended until next year. So it's still gonna expected to raise rates. The Fed is still expected to raise rates next year. You can see that last night, overall, the markets were in a sell-off mode. This is a day's performance snapshot. The Dow fell more than 700 points on interest rate expectations. Investors had hoped that moderating price pressures could allow officials to slow rate rises. And we knew that the Fed said that they cannot actually afford to basically they cannot afford not to raise rates and not to keep it high for a long time. So the Fed basically said that they will just keep the rates for a very long time and be sufficiently restrictive. So in that type of scenario, we can actually employ, as I said, alternatives to short selling. So the reason why I want you to learn about bearish put spreads is that a bearish put spread is actually a bearish strategy, but with a defined risk. So most people, their alternative when they're actually bearish in the market, bearish means that they believe that the market is likely to fall. So usually in a market crash, most people just hide into cash. That's not a bad thing, but hiding into cash basically will not pay the bills. It can pay you about 4% or 3.5%, 3.3%. IBKR pays that for your idle balance. But I don't think that is generally enough for a capital income of, let's say, less than $100,000. So generally speaking, if you want to actually make money with a bearish market, one way that you can actually employ with a defined risk is to actually learn what a bear put spread is. So a bear put spread is very simple. You are buying a put. So I think the most people are aware, but I will explain it again. A put option is basically a contract with a strike price, and you get to sell the company 100 shares for one contract at that strike price. So for instance, if the marketplace right now is $100 and you want to sell that company for 90 for a higher price, let's say $110, you can actually pay for a put option, and you're going to long a put to enable yourself to sell the shares at 110. So basically that put option, if it's 110, the strike price, and the real price today is 100, that means that that put option is $10 in the money. Okay, so why? Because 110 is greater than 100. So there are several ways of put options. There's an in the money strike price, there is an at the money strike price, and there's an out of the money strike price. So in a bear put spread, usually what you do is you go long a put, which is a higher strike price, and you sell a put, which is at a lower strike price, to reduce your cost basis. Because when you're buying a put option, you are paying, whereas when you're selling a put option, you are receiving or collecting credit. By receiving selling puts at a lower strike price, as long as you sell the puts at a significantly low strike price within the time frame, you can actually receive credit and actually lower your cost basis, making your defined risk as the maximum loss on your debit paid. So say for instance, you bought a put for $5 and you sold the put at $2. That means 5 minus 2, you get $3. That means you paid $3. So that means that your total risk is 3 times 100, since one contract is 100 shares. So the strategy means that this is a defined risk no matter what happens, because you paid $3 or $300. That would be the maximum risk that you would take for your bearish put spread. So even if the stock goes to the moon, let's say 100% higher, don't worry, because your buy put sell put will ensure that you will maximum lose only the debit paid or $300. Okay, in the long put spread, you could see that the maximum profit, of course, in your bearish spread is only the difference between the strike prices minus the debit paid. So let's say the strike price of your higher put is 100, and then your sell put strike price is 90. So 100 minus 90 is $10. So $10 times 100 is 1,000. Let's say you paid $300. The maximum gain that you will make is $1,000 minus what you've paid, which is 300. Therefore, that would be $700. So a bear put spread, I repeat, consists of buying a put with a high strike price and selling a put with a lower strike price just to receive credit and reduce your cost basis. Both of them need to have the same stock and the same expiration date so that it will cancel each other. You will not get assigned the stock price at any point in time. And you're just collecting spreads. In this case, you are paying the spread because this is a bearish put spread. So you are the one paying. That's why it's called a debit spread. So you profit when the stock declines in price. So let's give you examples here. So let's say you buy a put. Let's say the stock price today is 127. You buy a little bit at in the money. Okay, so 130 is higher than 127. So that is basically $3 in the money. So you're buying a put, which is $130. And then you're selling a put, which is an out of the money because it's a 120 strike. Now, if you think about it, 130 minus 120 is a $10 with spread. Therefore, your maximum gain is 10 times 100, which is $1,000. So let's assume that you bought the 130 put at about $4 and you sold the put at 120 and received something like $1. So your maximum loss then would be 4 minus 1, which is $3, right? Which is $300. And 10 minus 3 is $7, which is 700 maximum gain. So how would you make money in this position? Technically speaking, you will make money with a maximum gain of $700 when the stock price falls below 120. However, that doesn't mean that you're not making money if the stock price is between 120 to 127. In fact, your break-even price is 127. So the moment that stock 127 today falls just 127, just a dollar, you're already actually making money. Notice that your buy put here at 130 would be in the money for $4, but you only paid $300 for it. So your sell puts expire, and then that means 4 minus 3 is $1. So you make about $100. Notice that the stock price, as it falls, will make your gain go up and up to a maximum of $700 because we have a sell put at 120. Now, at the same time, how much your losses will be is capped at $300. So should the stock price go up actually significantly, so the moment it breaks above 130, since you have a buy put, that means that this would be a loss, but your sell put is actually gonna win. Therefore, every time it rallies above 130, say 135 or even 150, or even at $1,000, that wouldn't really matter because your sell put ensures that your buy put only has a maximum loss of $3. So that's the beauty of your buy put sell put, because the maximum cost was just your $300. That means your buy put expires to zero. Nobody would want to sell at 130 if they could actually sell to 140 or 150. And then your sell puts diminish your cost, right? So if this was a $4 put, but you receive a dollar collection here, your maximum loss is just $300. So that's really how to evaluate how bearish put spreads make money and lose money. So the nice thing about bearish put spreads is that you can actually construct, in this case, this is a risk of 300 and a reward of 700. So this is roughly 1 is to 2.6. So that's not so bad. 1 is to 2.13, right? So 700 divided by 300 is 2/1/3. So it's not so bad, but usually what you want to make advantage on these types of bearish put spreads is try to find 1 risk and 3 reward, or 1 risk and 4 reward. As much as possible, try to get a huge reward and pay a low risk when you are constructing your bearish put spreads. So usually you can make a higher advantage on a bearish put spread if you actually expand your expiry. There's actually a sweet spot on your expiry dates. If you want fast money, most people want to create their bearish put spreads at a 45-day to expiry. That is the sweet spot. Although you can actually tinker between the 30-day, the 45-day, and the 60-day. So that's what's been quite helpful for me. And then if you try to check even the 90-day to expiry for bearish put spreads, it could also be sufficiently good risk reward. So sometimes you need to pay a little bit more risk for a larger reward by extending your time frame. So again, your bearish put spread looks like this. You have a strike price, you have a strike price that's higher put, and then you sell a put at a lower strike price. That would be your maximum loss, and this would be your maximum profit, maximum loss. You want to ensure that your maximum profit that you made is actually larger than your risk, so that because normally a bearish put spread would have about 40% probability of being right. Sometimes you can make it 50% probability of being right. And so because you have a hit ratio of 50%, the best thing for you to ensure that you have a positive expectancy system in your trading account, so that it will be a positive profile after, say, 100 trades or 10 trades. With a 50-50 hit ratio, 5 trades would be winning. So 5 would earn, let's say, 5 times 3, let's say you earn $3. And then you lose 1. So 5 times 3 is 15 minus 5. That still means that you're $10, you're $10 profitable. So that would, or your $1,000 could earn $1,000 if you basically do the right system. So the pros of a bearish put spread is definitely this is less risky than simple short selling. As I said, most people, when they generate income in a falling market, they believe that short selling is the way. So the thing about bearish put spreads is that it's actually less risky than simple short selling. If I actually sell $1,000 of stock, or let's say $10,000 worth of stock, if the stock goes against me 10%, which is normal when you are trying to short, you could be wrong 10% before it falls down in your favor, you would have a $1,000 drawdown. Whereas if you make a simple short selling technique through bearish put spreads, you can make a risk of say $100 to $200 for the same type of name. We're talking about the same name. And even if it goes 10% against you, you can actually make a way for your total loss to actually be, instead of $1,000, to just be $100 to $200. This is why I'm saying that bearish put spreads is less risky with the same type of reward in the same name with almost the same expiry dates. Although I know that short selling shares does not have an expiry date, typically because short selling also involves a fee. Sometimes the fees could be extraordinary, like 25% a year or 50% just to short and borrow those shares. Actually, short selling due to the fees are not really the best advice when you are bearish the stock. The better, less risky way is to just enable bearish put spreads. Now, this works well in modestly declining markets. The reason why I say modestly declining markets is because obviously by employing a bearish put spread, you are capping your downside. You could, of course, just buy a naked put, but the naked puts would be more expensive than a bearish put spread. The reason why this works well in mostly declining markets is think that a stock could fall maybe 10 to 20% only within the next 1 to 2 months. It makes sense to actually make a bearish put spread. But if you actually think that the stock would fall and collapse 90% within the next 1 to 2 months, then definitely a naked put would be the better choice, because that means that your downside is going to be captured with that 90% sell off. Now, the nice thing, as I said, with a bearish put spread is that it limits your losses to the net amount paid for those options. So let's say you took a risk of $500 for a gain reward of 1,500. You can sleep well at night. You don't need to be awake all throughout the night, because the Philippines actually is 10:30 p.m. Philippine time when the New York Stock Exchange opens. So one reason that I really like to employ options is that I don't need to manage my position until, let's say, if I'm really wrong about the position, I would manage it if it's already 21 days to expiry. Because chances are, if you bought a put spread that you are wrong, you can already take a loss, knowing that your loss could be mitigated. So let's say you're wrong. You saw, for instance, like here, let's say your strike price of B is $125, $130, and the stock price is already significantly above that. Let's say it's already trading at $150, and you still have, let's say, 25 days till expiry. So given that you still have about 4 days just to wait for the position to fall, it's still better to manage your loss by closing the position outright. So if you're gonna lose maximum of $300 on your strike price, when the date to expiry is zero, make sure to manage your risk, especially if you're wrong, if you're out of the money, if you're wrong, manage it before it hits 21 day to expiry, because everybody knows in the options world that once an out of the money bearish spread is made 21 days to expiry, there is a very fast decay, and I'm saying 80% down within 2 days is very fast. So let's say your loss is let's say if it's a $300 position, you can still limit your loss to about $100 or $150, maybe around 30 days left to expiry or about 22 days left to expiry. But the moment it hits 21 or less, it's going to be a fast decay. And if you have a $300 risk, most likely you're going to lose about $250 already, with only just less than $50 to $60 to salvage if you're going to still wait for the next 3 weeks in order to be right. So, of course, the people love to limit losses, and you can even limit the losses not just to the net amount paid, especially if you know how to manage your risk if you are wrong on your trade. Just like, and it's actually cheaper to do that versus a simple short selling. Because if it was let's say if it is a $10,000 position and you're wrong already by 10%, you could understand that you're already at a drawdown of $1,000, even if there's no expiry date. Of course, some people say there's cons of risk of early assignment, but actually in IBKR, there's actually no risk of early assignment. Usually, the risk of early assignment only happens if you are already out of the money. So that the reason why this con doesn't happen to me, which is the risk of early assignment, is because if I'm wrong that I bought a put and I sold the put at a strike price that does not favor me, if the stock doesn't go down in my favor, you can actually limit the losses very quickly to actually avoid the risk of early assignment. Nonetheless, even if you have a risk of early assignment, don't worry about that because your buy put sell put negates that. Risk if the asset climbs dramatically. Now, on this risk, actually, every time you short a stock, obviously you could be wrong in the timing. So I believe that the risk asset here of climbing dramatically is quite common when you short sell a share and when you make a buy when you buy a bearish put spread. So to be fair, I don't think that these risks are limited to options. It's actually the same risk that you will take whenever you short shares. So if the asset climbs dramatically, what I like about shorting shares through bearish put spread is that your losses are limited. So it will not go above, unlike stock wherein, if you set a 25% stop loss, you would really lose a lot if you actually do not manage your risk quite quickly. So if you ask me, experience-wise, shorting shares would involve 10 times more risk rather than enabling bearish put spreads with the same type of reward and the same stock, same volatility. Now, they say that the con is to limit profits to the difference in strike price, but actually that is not a very difficult con. All of these cons are not really true because you can make a setup wherein your profits is at least 3 times or 2 times higher than your risk. As I said, you can generate a $100 risk and a $200 to $300 reward. It all pertains to how you find a good setup before you create your bearish put spreads, which is the reason why creating a bearish put spread profitable system is really possible. It's very mechanical. And if you're wondering how come with bearish put spreads being such a profitable strategy that nobody in the world actually utilizes it, the answer is they actually do, they utilize it, but it works in a mildly declining market. So when you are in a mildly declining market, let's say for the next 2 months, 3 months, it's a mildly declining market, or for the next 12 months, you do have to utilize bearish put spreads, right? So it is a case-to-case basis. The best traders in the world who consistently makes money in options for a living knows when to use bearish put spreads and knows when not to make it. So let's give you ideas. How about consumer defensives at short zones? Bearish put spreads, the reason why it will work in your favor if you know how to utilize a low risk, high reward. Because other people, what they do is they just buy puts and they don't even look at the risk reward. What if they would risk $1,000 and they would also lose, they would only just win $1,000, which is a 1:1 risk reward. So over time, even if they make 50 trades with a 1:1 risk reward, they're just going to break even at the end of the day. So it's very important that you choose to short not necessarily what you believe is the most volatile. In fact, more volatility is even a weak spot for you because a high volatility name means it is a high vega name. And higher vega means higher prices for the put options. And even if you make a reduced cost with selling a put, a lower strike put, it will still be very expensive. So let me show to you my techniques to help you find a low risk, high reward setup. So this is actually your consumer defensives. These are typical industries, discount stores like Walmart, supermarket. You've got household and personal products, which is Procter & Gamble. You've got Coca-Cola beverage, which is non-alcoholic. You've got PepsiCo, which is beverages in the non-alcoholic space. Although they also have entered the alco-seltzers, both of them. So they have been exploring also the alcoholic drinks. So we could argue that Coca-Cola and Pepsi are both in the beverage category of alcoholic and non-alcoholic drinks. Now, Costco is also in the discount stores format. You'll notice that with the CPI data coming in soft and the inflation actually peaking, that said, most of these stocks are all trading at about 30, 45, 50 times multiple. So we'll take a look on whether these most famous consumer defensives, which also pay a dividend, are really suitable to be bought in this market, or should the market be in cash? So we're looking at Walmart. One thing to note is that Walmart also happens to be at the top of resistance. For those who aren't really looking into the technicals about this, the most important thing that you just have to understand is that for the last 2 years, Walmart has not broken above 155 or 160 in a significant manner. Each time it goes above 155, it goes down. So 155 falls towards 130, 155 falls towards 130. What this means is that there is a valuation extreme wherein people believe that with high interest rates, Walmart does not deserve to be paid at about 35, 45 times valuation. So the earnings right now for Walmart is being paid 45 times multiple. And an added note, although Walmart is still in a technical uptrend, even if it is in a technical uptrend, you can make money in a bearish put spread. As I said, even in a mildly declining stock, you can make money in a bearish put spread. So in fact, all the bear put spreads that I've shown to you here only declined something like 5%, 6%, but we can make about 90, 100, 200% gains because of how we set up the trade. So let me explain how to do this. First, you need to do a filter screen. First, check are there insider selling. Walmart happens to have quite a huge insider selling, especially here at about $150 above. PNG also actually has a lot of insider selling from the directors, the presidents, etc. If you take a look, and it's actually happening at around 145 above. So nowadays, you're seeing that PNG is also trading near above resistance, near above their moving averages, and it's actually near its top. Recent top has been $165, which was retested in 2021 and retested in 2022. So this was your December 2021 top and retested around April, May this year. And this is a lower high, as you can see, at about 155 for Procter & Gamble. So Coca-Cola also is near the high end of resistance. You'll notice that for most consumer staples, they have barely fell. Basically, they've been an outperforming sector because they were defensive in a recession. But our argument is that even these defensive stocks, very well loved, considered safe haven dividends, are actually trading at quite expensive valuations and actually passed our short test. I'll explain to you how it passed our short criteria. But clearly, the chart setups tells you it has been significantly above the moving averages and overbought in terms of their ranges. Same as for PepsiCo, overbought in the range versus the moving average. Notice that these stocks are basically in very strong uptrends, mildly strong uptrends, but even uptrends can have all these corrective notes. Like what happened here, some correction of about 10 to 20%. So this is also a name that has rallied. This is a financial name, which is Sun Life. It is a weaker name. You could see downtrends all throughout, and it is trading below moving average. So what I'm gonna show to you is a function of two things. I've checked quite a lot of sectors, and of course, there's a theme that we are looking at, which is, generally speaking, we believe that people would like to own cash when cash pays 4 to 5%, rather than get themselves into equities. So for instance, Sun Life Financial usually manages bonds and equities. People would only voyeur into equities if they believe that they can make about 10, 20%, significantly higher return rather than make just 4%. So with an expensive market still, there's a higher chance that people might actually move their money towards cash, or probably some high yield bonds that are already offering about more than 10, 11% yields already and potential capital appreciation. So let me show to you what I've done. So what I usually do as a first principle is I do have a list of names. I try to manually type it out. So for the December 16, 2022, I try to check the 180-day expiry, which is roughly 6 months from now, June 16, 2023, and the lower the yields are of the puts, I take a look on whether I can create a 30-day or 60-day or 90-day expiry for bearish puts. So you'll notice that the moment that it is within a 3% yield or less, what it tells me is that somebody buying a put. So if you think about it, if I'm buying the put, that means somebody is selling the put. If the put option price is $1.40 for Yum Brands, this is the owner of Burger King. Sorry, KFC. KFC. Yum Brands is the owner of KFC, Taco Bell, and Pizza Hut. If somebody is gonna pay him or her $1.40, which is just 1.4% yield on a 100 strike, I think that it's actually such a low yield. It's a very low yield, given that a person can just collect the same 2% reward by park. In fact, sometimes even as high as 4%, just by parking the same cash currently in the treasury bills. So in a 6 month time expiry, anything that is paying 2% yield, if you're gonna be the seller of put, then you're collecting the yield. I believe that this is not a good risk reward for the seller of the put. That's why our thesis is we would like to buy the puts instead. So there's actually several ways to go about this. If you buy a put, then you can just buy a Yum Brands June 16, 2023. It would cost you $1.40. How do you do that? As I said, you can check this in your Webull account. So this is your Webull account. Let me see if you can see my screenshot here. Wait up. So I'm sharing my screen. Can you see it? Yeah, it can. Okay, so this is actually the platform of Webull. So what you need to do is just type it in, Yum Brands. Just click Yum. So Yum Brands is currently trading at 130. The nice thing is that you can see the chart. So this is the chart. You can see you can change the range. You can change it to 5 years. So this is the 5-year chart of Yum Brands. You can see that it went up near the highs of the year. And it's been a very strong outperform after dropping towards 102. So over the last few months, it has rallied back near its 2022 highs for Yum Brands. And we saw that the P valuation for Yum is quite expensive, even at these rates. Now, there's several ways to actually go about in shorting Yum Brands. As I said, of course, you can just short the shares. But if you'll notice, if you short 100 shares of Yum Brands, that would be negative 100. That would be $13,000 off your account. So what I said is that you get so much risk if you short the shares, because if 130 went just 150, you'd lose about $20 times 100 shares, which is $2,000. So how do we actually mitigate that type of risk? There's ways to do this. So go to Yum, go to the options. So first and foremost, what I did was I checked the June, right? So I said, check the June. Look at the 20% below price. So 20% below for Yum is about 110. And you can look at the yield, which is just $2.75 versus 110. You can even check the $100 is just 1.4% yields. So what it's telling me is that the Yum is actually very cheap put options if I want to make a naked put. But I can actually, what I want to usually do is make it a bearish put spread. So here's how to make a bearish put spread. As I said, the really sweet spot here is about 45-day. So you can actually choose between the 35-day to 63-day. So, okay, so 35 days for January 20, 2023. Let's take a look at how much to actually buy an at-the-money put and sell a put. So if you look at that, this is your Yum Brands. If you buy a put today, it's about $3.10. And if you sell a put at 120, it's going to be 0.6. So 3.1 minus collect of 0.6. So your real cost is just $250 with a potential gain of $750. The reason why you're going to gain $750 is because 130 minus 120 is a width spread of $10. So you pay 2.5 and you could potentially earn 7.5, right? So you can actually do this in your IBKR as well. Let me show to you how to do that for those who have accounts with IBKR. Let's show to you how to handle that exact trade. So let me open the account now. Okay, so it's now loading. As it loads, okay, as it loads, let's take a look at that. All right, so let's go towards the trade here. We talked about Yum. So here's how you do it. You click Yum. You just type Yum here. You type the ticker symbol, which is in this case Yum Brands. And then you go to the options chain. We talked about the January 20, which is 35 days. So you click that expiry date. We talked about buying a put. So we're buying the 130 put and we're selling the 120 put. So you can see that your loss is $250. As I said, you you pay 2.5 and you win 750. So it's a 1:3 risk reward. And the nice thing here is that they calculate the probability. So it says here that you get a probability win of about 33%, and you can even see your break even. So the break even of 127.49 basically means is that as long as Yum Brands goes below $127.49, you will make money. That's your break even rate. The moment it falls below 127.50, you start making money. The moment it goes above 130, you will lose money, but actually you will not lose as much. That would be just a loss of, well, maximum loss would just be $250. Okay, so here's how you do it. So you buy the put and then you sell a put, you click the order. So that would be a combo. That's called a bearish put, January 2023. You buy the order. Since you're paying, you just type in 2.5 and then you can make it day order. You don't need to make a profit taker and stop loss anymore because it's already a defined loss. We already know that we would lose $250 or we could potentially gain $750. Submit by order, accept. Now, of course, if you know that you are wrong, you can even lose less than $250. You can close it, say 10 days after or 5 days after. If Yum Brands indeed goes way, way above. Let's say it goes from 130 all the way towards 150. That's don't worry, you would just lose maximum of $250, which is what you've paid. But usually, if you have time expiry left, that means that there's still theta in the position. You won't lose the full amount of $250. Most likely, you can still salvage it by just losing $150, guys. Okay, so okay, there are some questions here. Sabi niya, short selling is Russian roulette gambling. I'm sticking with solid dividend stocks, monster dividend stocks, PBR, Petrobras, BHP Billiton, that's Starbucks. I know about those dividend names. Don't worry, Mr. Globalismo Blackman. As we said, it is not gambling because there is a defined risk and a defined reward. In fact, it works so well. That's why we are teaching it. For those who want to really make money, they need to know how to make money short selling with less risk. So listen up if you want to listen up how to make money. And if you don't want to make money, then forever be blinded. Okay? All right. So let's take a look again at some examples here. So I've already tabulated the best types of risk reward. You'll notice that the lower yields that you are paying, the lower the risk and potentially higher rewards. So you can set it up for Yum Brands, Procter & Gamble, McDonald's, QSR, J&J, TJ Maxx, PepsiCo, Berkshire Hathaway, Dow Jones, Coca-Cola, Sun Life, Walmart, the SPY, S&P 500. In fact, there was a time, obviously, of about 2 days ago and a week ago when these were actually cheaper. You'll notice that the SPY puts about a week ago or just a few days ago was $6.83. In just about 3 days, it went up to 13% up. So you can see that there are ways to actually take advantage of these types of put options. These are also categories that we are also showing to you that is also doable to make some bearish put spreads, which are Wendy's, AIG, Dollar General, Darden, Bank of America, Visa, XLF Financials, Microsoft, MasterCard, the QQQs, which is the NASDAQ, Dollar Tree, JP Morgan, Google, Ross Stores, Hilton Hotel, Starbucks. Now, also passing rate, although not nearly as good, is Marriott Hotels, BJ Wholesale Club, Texas Roadhouse. So again, that would be a bearish put spread wherein you are paying. Now, how about a bearish call spread? A bearish call spread is also a way to collect money. In this case, it is a high probability rule that you can actually create a bearish call credit spread wherein you are making the selling of the puts, and then you are selling of the calls, the out of strike, out of the money calls. You sell a call and then you buy a call. So I'm going to tell you how that works. Basically, since you are selling the same number of calls and purchasing calls, you will get a profit, but that is the total credit received. Usually, because a selling call spread will give you a reward, usually the risk reward ratio here is risk of 3, reward of 1. So it's the inverse, kabaliktaran. But the difference is that this has a high probability of making money. So usually the probability is about 75 to 90% that you will make money from this. Meaning, even if you just collect $100, but you win 9 times, so 9 times 1, and you lose 1 time and you lose 3. So 9 minus 3 equals 6. So you still have a positive expectancy value as long as you keep on continuing to keep on grinding to make those credit spreads and accumulate those gains monthly, weekly, etc. So as I said, bearish call spreads are made by actually having 2 call options. You have one sell call and you have buy call at different strike prices, but with the same expiration date. Again, this is a limited risk because the buy call will, of course, stop you out from further losses if it goes up and away. And then, of course, you can also, so you can contain your losses. The nice thing about bearish call spreads and bearish put spreads is that both of your losses and your gains are capped. So it's capped. A bearish call spread is usually done because modest downside is expected. As I said, you use this when you think that the stock would fall 10%, 5%, 20%, not like 50, 100% drops. So modest downside, it's very useful for that type of movement. And then if you believe that the volatility is high, you can make a bearish call spread because you will sell that volatility. Because the higher the volatility, the better off for you. So when we talked about these names, these have very low volatility. You don't want to make bearish call spreads here. These types are useful for debit strategy. For a credit strategy wherein you are receiving, what you want is very high premium. So you want the volatility to be very high. So you want the call options and the put options to be very expensive. So the reason why you like this is that the maximum loss is basically the difference between the width of the strike price of the calls versus the credit received. And then the maximum gain, of course, is the credit that you receive. Usually, as I said, Webull has 0 commission. So commissions is negligible. Now, even in interactive brokers, the commission is negligible for options, around just $1. So it's really, really useful instead of shorting shares. This is really an alternative instead of short selling shares. Learn to employ bearish put spreads as a debit strategy and learn to sell credit spreads, i.e. you are collecting credit, which is you're selling out of the money calls. So a bearish call spread is a very suitable option strategy to collect income, generating premium income, especially during volatile times. However, given this strategy's risks outweighs its gains, it should be only used in a very sophisticated manner. Because sometimes, even if you have a 90% win ratio, if you could potentially lose 5 and only win 1, you have to think whether you want to take that. Because sometimes the risk could be 8 and then the reward is 1. So it might not be justified even if 90% hit ratio on collecting the 1. Because what if you end up having the 10% loss ratio, losing 8? So let's give you an example. This is Celsius Holdings. This is one of the relatively high volatile names. Very expensive puts, very expensive calls. You'll notice na in January, which is just 35 days, the at-the-money put option is already 10% yield. Very expensive, as I said. So what if instead of buying the puts, of course, what we do is if it's very expensive, we try to sell the calls. So an at the 110 is actually selling calls, which is you will collect $8 and then try to buy the 120 calls, which is out of the money call. So let's say if Celsius goes above 120, don't worry. Your maximum loss will be capped because 120 minus 110, it is $10 and you receive $3 here. So what this tells you is collect 3 lose 7. So it's about 1:2, no? 3.1, 6.9. So ganito yan, maximum return 3.1, maximum loss 6.9. You sell the 110 calls, di ba? You receive the $8, and then you buy the 120 call, which is an out of the money call for $5. Maximum profit 3, maximum loss 6.9. If you ratio that, that's about 3:7. So about 1:2.1/3. Your probability of profit is 60%. So you break even at 113, meaning if the stock price of Celsius, which is currently 107, remains 107, guys, panalo ka. You win. You only start losing if it goes above 110, diba? So if it goes 110 but you receive naman $3.11, your real break-even rate is 113.11. You only start losing money when it goes above 113.11. But you will not lose the maximum loss of 689. You would only lose maximum loss of 689 when it goes above 120. So let's say the stock price Celsius closes at 115. How much would you lose? So in a 115, diba? In a 115, since you have receive a profit of 311, diba? So 115 minus 110, talo ka ng $5. So 500, so 311 minus 500, you would lose something like $189. You didn't lose maximum loss of 689. You would only lose maximum of 689 if the stock price closes at 120 or higher. The nice thing is, if Celsius, let's say, biglang nag-gap up, you didn't know na somebody like Pepsi bought Celsius shares for about $130. No, don't worry, your maximum loss will just be 689. So, diba, sobrang ganda kasi no matter if Celsius hits $500 pa yan or $1,000, don't worry about it. Maximum loss would be 689. Now, how about winning? What if Celsius closes at 107? So if it closes at 107, guys, what would happen here is yung sell call, buy call mo, you received a credit return of you received 311. So your sell call, buy call becomes in the money, right? So wala, bale, you receive maximum return 311. In fact, panalo ka, technically. So yun, that's why 60% of the time, panalo ka. Kasi as long as Celsius trades actually 110 below, you already win. 109 pa lang, panalo ka na. It doesn't even have to be 107. Automatic, 109.99 kasi sell call mo is 110. Once the price of Celsius is below 110, automatic return ka of 311. Diba? Ganda, no? So that's one of the reason why a lot of people likes to short bearish calls, even if so actually I found you a very nice risk reward. Kadalasan, you can even find a risk reward na risk 10, reward 2. May mga ganon. Or risk 8, reward 2. Yung Celsius na bear call, that's really, really good. So actually, that was I had to manually really look for stocks that have high volatility. And it's really a very good premium to sell into. So now that you learned how to buy a bearish put and sell a bearish call, let's see if you learned something. I'll show to you an actual trade that I've made over 2 days ago and my current trades tonight, which I think I can still add for further shorting tonight. Let's show to you how to do that. No. Here, you can see in my trade, I have posted orders and trades. So I bought a Yum Brands bearish put. Let's see if you can understand. Here, I bought a Ross Stores bearish put, Jan 27, 2023, 115 strike, 110 sell put at the lower end. I buy it with a $2 entry point. So that means risk 2, reward 3. Kasi 5 minus 0, diba? Kadalasan yung mga nakalagay dito, bearish puts. PNG, I made a bearish put. Yeah, pakita natin sa inyo yung mga bear calls. Okay, this one. I am selling, well, kahapon kasi to So kinancel ko na. I've already made this trade last night. So I'm gonna show to you an actual sell call that I've done last night. So this one for Dow Jones, I sold a 350 call and I bought a 355 call. So I sold $6, so I received $6 and I paid 4.5. So the actual net profit that I've made is $150, right? For the Dow Jones, DIA. So look at that. Let me show to you that exact trade. This is Dow Jones. Actually, makita mo rin yan sa dito. So let me show to you sa Interactive Brokers. You click DIA, then you go to the options chain. So I sold the 350. So you'll notice that selling 350 is selling an in the money call, diba? An out of the money call. So let's go to anong expiry date ko nun? March. So go to March. I sold the 350 and then I bought the 355. So kahapon, I could still make a return of $150. Today, if you make it, you'll just earn $100 and your maximum loss is $400. So as time goes by, talaga guys, the faster you sell, habang mataas pa yung returns niyan, like the 2 days ago, I think meron pa yan, parang yung risk reward, ngayon 1:4 na lang diba? Kahapon, 1.5:3.5 yan. In fact, there was a time na 2:3. Maximum return 200, maximum loss mo $300 with a very high probability. So ito, you can see that probability of profit is 70%. What it's telling you is that if you sell the Dow Jones 350 calls and buy the 355 calls, net profit mo is 100. So if you do it, 7 times panalo ka ng 1, so 7 times 1, 3 times na magkamali ka, you could potentially lose $4. So, yun, ingat lang kasi the more that you are wrong, 'di ba? 7 times 1 minus 12, magiging negative value ka, negative 5 'yon. 'Di ba? So, ingat lang. Usually dito late ka na Kahapon maganda pa yung return reward nito. Ngayon, pag ganito, pina-pass out ko na to. Pass off na 'yan, no? So 1:4 'yan. There was a time na return yan was 200, which was about 2 days ago. So yun, if you'll notice, yung mga bear calls, kailangan guys, masipag ka rin. Masipag ka, and this is what we also do in our Awesome 10X membership. No, I do that. Ako na yung nagsisipag. I look for the ones that have really good risk rewards that you will take. No, risk mo 100, but reward mo is potentially 200. With a high probability ratio. So here, if you want to see what exactly were these, this was actually a bear call. So I sold the SPY for $24.39, received $1,000, but you'll notice na $200 gain, loss of 1.7 if I'm wrong. Pero that was a 90% hit ratio. So tinake ko pa rin. So it is case by case basis kasi like if you notice, it makes sense to make a bearish call if you, especially like last 2 days, alam mo yung top was the CPI data. So here, very very clear, the Dow Jones stopped at about 349. Kitang-kita yan, especially when you saw the entire market, soft CPI yan, sinell off yan So Dow Jones 348 all the way to 340 after rising nearly 2% up. This was also the same that happened in the QQQs and the SPY. So it takes a while, it takes preparation to make the best risk-reward trades. That's why, guys, it's not considered gambling. Gambling is somebody who's making trades without even recognizing the risk-reward. Ito, naka-define risk, naka-define reward. And if you really make it a system, guys, you will really make money. So this is my gift for you guys. If you treat our lessons as gifts, treat it as a gift. And then for the people who like dividend names, I've been checking energy names. I do like energy. So the only reason, so Petrobras, BHP, those are typical energy dividend names. The reason why I haven't made a bullish entry yet on the energy names is because I'm still waiting for the market to give energy names at a healthier pullback price. So I'm just waiting for time for the risk reward to be in our favor. When the edge is on your side, that's when you execute. And right now, all the edges are pertaining, at least for this month, for December, and maybe until the next 2 to 3 weeks for January. The best risk rewards are to sell bear calls, the high volatility ones. You can find risk 2, reward 3, and also to buy bearish put spreads on consumer defensives, staples, even the banks. But for the banks, medyo na late na kayo kasi 100% gain na yung banks, yung mga nag-bearish spreads. So this is proof that the system works kasi what I just taught you was the exact recipe how these gains were derived. And if you follow my Faces Trader Twitter account and if you follow our Awesome 10x YouTube every week, makikita mo that when we initiated these bear puts from unchanged, 60%, 100%, hit ratios yan, lahat tama. It happened because we entered when the risk was very low. Imagine mo ito, lose $800, potential gain 2.4. So within 2 days pa lang, 100% gain na. No? $900 risk, already earning $900. But actually this NVIDIA bear spread, this can win $2,400. Maximum gain yan. So if you look at that, ito yung NVIDIA. We entered the put option spread on NVIDIA sakto in the last 2 days here at the peak. So yan, the stock price went, kahit dito mo in-enter sa $182, not necessarily here at the peak na 187. Even if you entered the bearish puts here at 182, panalo ka ng 97% with the bear spreads. So I don't know about you if you're gonna call it gambling. For the people who call it gambling, let me reiterate, this is not gambling. This is a system. You can search all throughout Google. You can search all throughout any other trader who's been utilizing bearish put spreads and made it a career. It's really a highly effective system, but these trades don't come often. That's why it's important that when it's there, you take it. If you take it now, wala na. Lugi ka na. Kasi right now, you're gonna have to risk 1.6 to make 1.6. 1:1 na yung risk reward mo. Whereas 2 days ago, risk 800, win 2.4. So may mga ganun talaga. You have to really understand, pag risk reward is 1:1, stop playing. That means na wala yan, nagko-coin flip ka lang. Even if tumama ka man, because 50% of the time, tatama ka talaga, it's not really a system. What you're doing is real gambling. 1:1 yung risk ratio mo eh. The moment na you learn how to, dalawa lang yon. Either your hit ratio is very high, which is credit spreads. Gagawin mo, 90% of the time, you're collecting the gain, although small gains. Ang problema lang doon, mentally speaking, I told some people who love credit strategies, you could be right 9 times, and the last time, yung 10th time na magkamali ka, you give back 50% of your gains, masakit yun. Because a credit strategy is really 90% probability you're right, but you will gain 1. And then the 10% of the time that you're wrong, you could potentially lose 4, 5, 6. Diba? So it's still positive expectancy, pero masakit pa rin. Let's say, for 1 entire month, you've been grinding, panalo ka na ng, let's say, $9,000. Minalas-malas ka. You followed your system, your 10th trade is wrong, you had to give up $5,000. You're still up $4,000 for the month. But it might not make you so happy. But the system is fine, okay? Collecting credit, ganyan talaga yung style. How about you make, instead of collecting credit, masanay ka maging master of debit. Or you become masters of both. Importante, on a debit strategy, buy low. In a credit strategy, sell high. Yun lang yun. buy low yields or sell high yields. Yun yung kailangan mong i-master. Now, with the debit strategy, hindi ka magkakaroon ng 90% probability. Maswerte ka na kung makakuha ka ng 55% probability that you're right. Tapos yung risk reward mo is 1:3. Very rare yon. Yung mga 1:3, risk 1, reward 3, risk 1, reward 4, risk 1, reward 7 or 5, ang probability mo of being right would be calculated as about 30 to 40% hit ratio. Nonetheless, if you think about it, if you win, kahit na 4 times out of 10 lang, 4 times 7 is 28. Kahit matalo pa yung other 6 mo, 6, di ba? Minus 6 lang yon, 28 minus 6, 22. Ang laki ng system edge mo nun. That's why ako personally, if you'll notice, I prefer making bearish put spread because my risk is limited, my reward is larger. So when you see the reward, nakita mo, wow, gain na si Nikki 100%. Don't say na that is great. Kasi the actual reward there should be 250%, should be 300%. Kasi I chose the setup where risk is 1, reward is 3. From the onset, from the beginning, ginawa ko yon. That is what a bearish put spread is. Yun yung maganda doon. The problem with others is they're not patient enough. Panalo sila, but they will not wait. They will collect their profit. I told people, if you're gonna do that, nagiging 1:1 yung risk reward mo. Paano kung next time mali ka? Eh di ba 40% probability lang natatama ka? Or 50% probability natatama ka? If you always trade with a 1:1 hit ratio, you'll see that your account will just be break even. Now, for others, sasabihin nila at least break even. But that's not how to make money. You're making money, you're trying to trade money to make money, not to break even. Of course, not to lose money, right? So, it's very important for everyone to have a system, to be patient with the system, and to really follow the risk reward. Now, how do you manage when you're wrong? As I said, before the expiry happens, you can manage naman, makita mo. Within 1 day or 2 days, kung nag-gap up yung sinashort mo, mali ka na, huwag ka nang stubborn. Pasalamat ka, defined loss ka. If your defined loss is about $300, pasalamat ka if you're just gonna lose $150 on it, lalo na kung gumap up. I made the mistake, nag-short ako ng belly, Chinese stock, nag-gap up yan ng mga 10%, tapos 20%. I was happy to have lost just 50%. My risk was $120, I lost $60 still in my system. What's important, guys, is that you follow a system. You don't really look at kailangan ba lahat gain. Of course, when the market is conducive to bearish put spread, I should suggest that you should make the most money as much as possible. Because right now, the market is mildly bearish, conducive for bearish put spread, and selling bear calls. Make the most because today I checked my filter screens. Actually 29 names passed my short test. I could create 29 bear puts. Lahat yon pasado with a low risk, high reward. So learn to be aggressive when you have to, and learn to be in the sidelines when you don't have any trades to make. Because there will come a time na after 1 month, wala ka nang pwedeng i-short. Bumagsak na lahat, tapos na sila, wala ka nang risk reward. In fact, after 2 days, some risk rewards, not allowed na. Some people ask me, pwede pa ba nila i-short Goldman Sachs? Sabi namin, too late na. We were giving the shorts on Goldman Sachs about 2 weeks ago. If you short it now, medyo late ka. Well, 2 weeks to about 2 days ago, nung December 1, December 6, December 13, medyo optimal pa to short. Pero ngayon, December 16, if you're gonna short Goldman Sachs, even if you will be right, 1:1 yung risk reward mo. Meaning, you could lose $30, win $30, which is not what a trader that is profitable should do. Edge should be on your favor before the trade even starts. For those who really want to explore and understand what is a bearish put spread, what is this bearish call spread, I may not be the best explainer, but hopefully through watching my trades vicariously, you can simulate this, open an account in IBKR, open an account in Webull trading platform, open $2,000. You can open paper trade, you can open the real live account. So usually I would suggest, especially for the starting ones, $2,000 lang i-open mo. And then open the simulation. Mag-simulate ka muna, explore the bearish put spreads, explore the bearish call spreads. Pagkatapos mo mag-simulate maybe for 1 month or 2 months, saka mo i-live. And make sure that when you start with your live, when we say, defined risk, $300, matulog ka na alam mo na pag nagkamali ka, $300 loss. So usually what I would say is in a $2,000 account, maximum risk mo, actually, in the portfolio that I manage, I find myself already aggressive with a 3% portfolio risk. Meaning, if my account is $100,000, I would risk $3,000 for my total account. If I am really, really aggressive, i-risk ko dyan 5%. Open potential drawdowns yon. So kung $100,000 account, malulugi ka ng 5,000. At any given point in time, within the day, within next week, masakit yon. But kaya nga for others, they actually teach 2% portfolio risk rule lang. Ako nga, I'm doing it 3% risk rule. So medyo aggressive na yung 3% risk rule. So let's say your account is $2,000 talaga. A 3% risk rule means $60 risk lang, no? Modify natin. Sige, sabihin na natin it's a $2,000 account. Sige, magpatalo tayo ng $100 if ever per trade. $100 risk, but make sure your reward is $300. Over 10 to 20 trades, you should be able to see the system is working. As long as you really follow a 1:3 risk-reward system, walang dayaan. You know yourself. Pag nagtitake ka ng 1:1, kasalanan mo yon. Kasi minsan tama ka, but you will collect the profit. So hindi mo nakukuha yung 3 na reward. Kasi sa 1 pa lang, kinuha mo na. You risk 1, but you take 1. So kailangan, guys, systematic. Just because you're correct. So I said, okay, you took profit, but you didn't follow your system. The system told you to trail. It was not to take profit. You have to really be honest with yourself kasi sometimes the reason why our system is not profitable is because we aren't following the system. We are deviating from the system. Either we really cut our losses short, let your winners run. In this case nga, we're not even letting our winners run eh. We need our winners just to hit our target. Kahit na maging 500% dapat, kung talaga ang target mo is risk 300, win 900, just follow the 900. Wala naman magagalit kung, well, in the first place, in our bearish put spread, hindi rin naman talaga magma-maximum gain ng sobra-sobra yan. Kasi from the onset, kinakap natin yung upside. Talagang to lower the risk, we will cap the upside. But the point is that we're not taking a 1:1 risk reward here naman eh. We're still making a 1:3, 1:2, 1:4. I think you should also recognize what is really my reason for shorting the name. So dapat you have an idea. One of the reasons why we are shorting the Dow Jones, the S&P 500, and the QQQ isn't just because sobrang liit ng risk and then the reward is greater. It was, in about 2 days ago, it was just about 1% risk, and I could potentially make about 400, when my $100 risk would gain $400 reward. So parang, in fact, I was telling myself, kasalanan ko na if I don't execute. Kasi the market is giving me a risk 1 for reward. And if I only allocate 10% of my portfolio, which is just gonna be a very, very low risk, yun, kasalanan ko na yun. Kasi minsan, I noticed, when we lose money, when we're trading in a slump, ayaw na natin matalo. Even if the system is telling us, lahat ng panalo comes from following the system. If the system tells us to short, siguro nag-short ka, tapos maaga ka naka-short, tapos nagkaroon ka ng drawdown, natatakot ka na mag-short ulit. To short. And the system tells you the risk is 100, the reward is 400. You should still follow the system. So it's very important for those who don't understand how to create systems na, yeah, you can follow Awesome 10X. You can register in awesome10x.com. You can do personal review. That's something that we help our members to do, especially those who really want to understand how to generate income in a falling market. Kasi, of course, we can just tell you, sige, park it in cash, earn the 3.3% interest balance on idle balance. Not so bad, di ba? You can make money just doing idle. Wala nang gagawin. Naka-park lang yan sa dollar, tapos tulog ka na every day, make money while sleeping, may interest money. Right now, may interest money na pumapasok. Basta matulog lang yan for 1 year. Monthly, credits account mo. But other than that, I think that when time comes, every month, minsan makaka-generate ka ng 3 trades na talaga. We're not saying naman na in a month, nako, 20 trades, dami-dami. There are days, I would say na there are days na 30 trades pwede gawin. In a single day, 30 trades kaya mong gawin with an optimal result. And there are days na kahit anong pilit mo, wala talagang set up. Matutulog ka lang talaga sa gabi kasi you did your work, but there's no setup. You cannot do anything. So, ganon. So, yun. That's really the life of a person who's actively trading, actively generating income from the market. Most people like passive income. Credit strategies would still work. But, so I make it easy for you by teaching you how to sell credit. But you have to make sure na yung 90% probability of the time, talagang you follow that. Actually, 75% above yung probability. Di naman talaga lagi 90% probability. Like yung kanina, I'm willing to make a bear call on sell H. 55% probability lang siya maging tama, but I could potentially earn 200 and only lose 300. 1:1.5. So not so bad. So yun, think about yung risk-reward kasi that is the only way for your system to be profitable. Of course, if you adopt the insider selling and then, kasi an IBKR can only calculate mechanically. Even if IBKR will tell you 30% probability lang for you to be right, you can collaborate naman eh. Nakikita mo, S&P 500 is falling. You're seeing Dow Jones fall. You're seeing Nasdaq fall. You're seeing the dollar slowly climbing up. You're seeing the treasury yields going up. So it means na yung bearish idea mo is correct and you're seeing earnings downgrades. Kumbaga, you have a lot of information and not just a single chart and not just a single setup. You have to recognize, especially when you're doing this, how many setups yung available today to short versus dati na halos wala kang ma-short kasi naghihintay ka pa ng resistance. So ganon. That's it. Have a good night and hopefully I will see some of you open Webull accounts, open your interactive brokers accounts. For those who are new, I do suggest open your Webull account because really for options, 0 commission, 0 stock fee, 0 stocks rate, walang commission. If you buy Apple, if you buy Google, any mutual fund, any ETF, it's 0 commissions, 0 fees. So basically it's the Robinhood of Singapore. It's available for us. So definitely very convenient for the Singaporeans, but it's not just for them. It's very convenient also for Filipinos. Slowly, with these types of promotions, capture them. You don't need to open a big account. As I said, $2,000 is enough. Get one account. Use our link in our thumbnail and learn how to generate income by selling credit spreads, and generating profits from buying bearish puts. Thank you, and that's it. Bye-bye.